series where we're going to dig deep into one particular topic. So the topics are not all related, but the theme is we're just going to dive deep into whatever one we picked. So our next event after this is going to be held on January 8th at 3 p.m. And our next topic is going to be eating healthy after the holidays. And I'm excited that we'll have a dietitian from Hy-Vee available to answer all of our questions for that event. So that'll be great. But today we're going to talk about taxes, and specifically about taxes for your side hustle. So if you have started freelance graphic designing or doing anything as a freelancer separate from your regular job, that can kind of add some layers to your taxes. It also has some effects on what you can write off as expenses and what you maybe can't write off as expenses. So full disclosure, I thought of this topic because I do some work as a freelance writer in addition to working for City of Marion. So it took me a few years to get the tax end of things figured out. The first year, I know I didn't write off everything that I probably could have because I just hadn't learned everything you can do yet with freelance taxes. So that's why I thought of this topic. And today we have Kim from Jim's Tax Service joining us. Jim's Tax Service is a local business here in Marion. So I'm excited to have her with her today. Kim, do you want to introduce yourself?
Sure. Is this where I hit start video?
Yeah.
Sorry about that. Anyway, like you said, Kim with Jim's Tax Service. My dad started doing taxes about the time I was being born. So he's done it for a long time, and started learning from him, taking my classes, and now work side by side. And we do handle a number of people who, like you said, have a side hustle on the side of, maybe they have a regular W-2 job, but they, a lot of people who do direct selling, or like you said, writing, more people, and again, with the things like Uber and Lyft driving nowadays too.
Mm-hmm. Yeah, I do feel like that's getting more and more common to supplement income, or even if you lost your job this year, I'm sure more people are kind of exploring the world of what freelancing looks like. So I thought this was a great time to talk about it. So Kim is going to share some slides. So what we're going to do is go through some basic information. And anytime you have a question, just enter it in the chat box and I'll keep an eye on that. So anytime, you don't have to wait till the end, just throughout the presentation, just enter your questions in there, and we'll go ahead and get started.
All right, sounds good. Let's see how I'm going to do on this. All right, looks like that's the right slide to start with. So yeah, I just wanted to see, when you're doing stuff as a side hustle, you're generally meaning to do it for income or profit. There's people who will have more of a hobby, like they receive a prize for submitting a photo to the fair, and as long as it's something that you're not regularly being involved in to produce income, that's kind of a one-off thing, and has a little different tax effect. So say someone as a hobby takes photos, took some really nice ones, won some prize money at the fair, that goes on a different line on their tax return, and they only get as a deduction what kind of went into any consumed costs or cost of goods sold for that type of income. On the flip side, when you have a true business, you're in it for some income and profit. You have a continual involvement, regular involvement. That opens up, like you mentioned before, a lot of options for kind of your operating costs that you can use. So with that, just kind of discussing what could be your income depending on what type of business you're in. You might be selling something outright. You might just be taking in income for services rendered. You might receive prize money, and as long as you're involved in a business, then that prize money is income for the business. Royalties, I mentioned that one just because of writing or producing a song, something like that. A couple of lesser thought of things if you barter. So say you produce a service, like you do an oil change for someone, and instead of paying you with cash, they pay you with oil or something, like whatever it is, whatever the fair market value of what you receive is still going to be part of your income. And what's become more of a focus for the IRS has been if you use virtual currency like Bitcoin and you receive it for doing services, it's got to be translated first into US dollars at that time, but it gets recorded as income for you. So the income usually isn't too hard to put together. It's more, what can I use as my expenses? Let's see. So there's two vocabulary words that go with expenses. Ordinary. So it's common, it's expected in whatever industry you're in. Good example of someone who's running a ride sharing service, working for Uber or Lyft or something like that, is going to be maybe providing water in the car when you pick them up at the airport, that kind of thing. And necessary, the other part of it is it's helpful. It helps you run the business. So pretty expected that you would have your car looking nice. So the some of the upkeep costs would make sense again for that kind of business. And so there's all kinds of categories on the typical form that you reported on your taxes with a Schedule C. The form is meant to work for every type of business out there. So you might not find exactly what you want for description, but that's why they've got the other category on that form too. So you're gonna find a way to enter it and record it, so you get your expenses.
Yeah, and before we go too deep into expenses, someone asked a good question. Want to know, how frequent is too frequent for income to be delineated as a hobby versus a business? And is it really about the frequency, or is there a certain dollar amount that kind of delineates hobby versus business?
I mean, they'll talk about, you'll hear people say things like, well, if it's less than 400 or less than 600 or whatnot. Those are benchmarks for when different types of tax or types of forms that have to be issued go with. They're not really, there's not really a dollar amount that the IRS would consider too low to be part of a business if you were pursuing something on a regular basis. So I guess the thing to think about with whether it's more regular than a hobby would be, if you have this might get a little deeper than you want to go, but there's 9 traits that get more specific about whether something is being run in a business-like manner. But this might help answer their question rather than just focusing on how often they get income from it. If you're engaging in activity with expertise, either yours or people you have advising you, and you are running it in a business-like manner, like you're keeping the separate records and working on improving your income from it. If you are showing, income from it, for one of the guidelines is like for 3 of the last 5 years, and in it for profit. it's a lot of it's intent. Um, so, just a personal stuff that I do includes kind of as a side hustle, judging contest speech at the high school level.
Hmm.
And they only have, generally 4 contests a year between the state and regional and, I'm sorry, district and state, and um, both individual and large group. So there can be years, this was going to be a really interesting one as far as dealing with COVID, where I might not get to judge more than one contest. And then there's years when I judge 4 plus another couple conference level contests. But that one, even though it can be, one year I get $100 for judging one contest, another year, there's the, $600. It's something that is not exactly a hobby. It is always, going to have that profit, going to have that expertise in it. I stay licensed in it. So that one, though the dollar amounts, are a lot of times below that thought area or frequency area, I consider it, the intent of it is still as a business activity. And again, that might get more information than you want, but at least it gets you into the facts and circumstances, which is how the IRS will judge it.
Gotcha. That makes sense. So it's kind of more about, not so much about the frequency of how often you do something, it's more about the intent. Is that right?
Yeah, yeah. You'll hear frequently when people are talking about how audits are decided, how tax court decisions are made. What are the facts and circumstances of that case? And you have to be able to support your position. So having a lower dollar amount or a less frequent time period of or frequency of getting income would weigh on the side of it not being a business, being more of a hobby. But you also have to consider some of these other things like experience in it and how you pursue it and how you handle it, how you stay licensed, that kind of thing.
Gotcha. So it's fair to say if you've set out to make money from what you're about to go do, you should go ahead and probably consider it as a business.
Yeah, pretty much. Yeah.
Perfect.
Okay. I mean, and the nice thing, like I mentioned earlier, if it's a hobby that you're receiving a prize money from, for example, it's still income. It's not subject to self-employment tax, but you also get very few expenses you can use against that hobby income before the remainder of it's taxed at your income tax rate. So it's kind of nice to have it be a business. And then you really do want to keep your records of every expense that is tied to it, so that just like if you're a W-2 employee, the employer for you is going to look for the expenses tied to their business beyond your paycheck. It's also going to be all the overhead they have tied to it. So the overhead you have tied to your business, ideally you're paying attention to what it's truly costing you to produce that income,
Mhm.
um, and paying tax accordingly. So
Absolutely.
let's see. Oh yeah, I wanted to make sure to point out a lot of the times with the side hustle, particularly if it's involving either giving rides or nowadays delivering food. Um, and then there's also going places to do direct selling. You're going to use your car. And the 2 ways you can take an expense off for your car. You can either use whatever the current year federal standard mileage rate is, or your business use percentage of your actual expenses. Either way, you want to keep track of your mileage. You want to know how many miles you put on your vehicle in the year, and you want to know how many of those miles were in pursuit of your business activity, whether it was actually providing a service, um, picking up supplies, or going to meet with a client or to do a job. And the 57.5 cents a mile is the 2020 number, just down a half cent from last year. 2019 was 58. And it's meant to cover all the overhead that's involved with your car. Depreciation expense is part of it. It's meant to cover the wear and tear on your vehicle. So it's probably the most straightforward and comfortable way to put it together. But you can, I definitely have clients who do keep track of every bit of expense into the car, and then we'll always compare for that year, what's the better deduction, whether we take the standard mileage rate for the miles they put on that vehicle, or whether we, take the, miles they put onto it divided by the total miles, multiplied by their expenses. So, if you use it half the time for your business, then you only get half of the expenses to maintain and drive that vehicle. But that adds up pretty quick. The different returns I've done that have had Uber or Lyft on it, it sure seems like most of their income is eaten up by the wear and tear on their vehicle. So slightly precautionary tale about trying to make money that way. You're putting wear and tear on your vehicle. So
I know I started adding this as an expense when I would actually drive and go interview people in person for articles, which hasn't happened for pretty much this entire year, but I did used to do that. And driving from Marion to Cedar Rapids, for example, that did add up quite a bit as far as expenses I could write off goes.
Yep, it does. There's absolutely, it does. And taking it out of a business, a side hustle, is the only way you get to take it off. Driving for a W-2 job used to be something that if you didn't get reimbursed by your employer prior to tax year 2018, you could deduct it if you were itemizing on a Schedule A. But now you just, if you do a lot of driving for work, ideally the employer is reimbursing you, because they can still take it as an expense, but you no longer can do so. So that's a side note, but yeah. Oh yeah. So here's some things that you don't necessarily, it's not like going to the office supply store and picking up office supplies, or going to the post office and picking up stamps. You don't necessarily have a receipt that you're thinking of as an expense. But a lot of the businesses, the side hustle, whether it's driving for Uber or direct selling or whatnot, you're doing a lot of your work on your cell phone. A lot of times people just have the one cell phone. It doesn't always make sense to have two cell phones, to have one that's business only. So you're looking to see what you paid for the cell phone for the part of the year or the entire year if you were doing that business, and taking a percentage of that cost that ties to how often you were using it. Data plans and that kind of stuff might provide a little more guidance to see how your bill breaks down. Sometimes we're just really straightforward about it to say, okay, I only did a little bit of business this year, maybe 10% of the time my cell phone was being used for business. And so we go through what bills we have and do the 10%. But it can add up, particularly if you're growing your business into full time. So that can be an expense that you want to watch for. And again, with the internet, a lot of times it's just on your cell phone anyway, so it's part of that billing. But there's also a reason sometimes to have the home internet, and could be security, for what you're doing, it could be convenience, but whatever portion of your home internet would be for business use. And then that last one on their business use of the home, if you have a dedicated area of your home that doesn't get used for anything else, then that can be another expense that you treat as a deduction. There's a couple of methods now. I think about 5-6 years ago, we got this simplified method, which is very nice, where you basically take the square footage of the area that, again, is exclusive use for the business, um, and the number of square foot up to 300 square foot. You can use the simplified method and just take $5 a square foot if your area is exclusive the entire year. There's also the actual expenses. Again, kind of similar to taking mileage on a vehicle. You take all your expenses for your home. Uh, it might be rent, or it could be actual, like my mortgage payments, property taxes, um, insurance, utilities, whatnot, and take the business use percentage. So that, again, you wanted the square footage of your space. But the simplified method obviously is a lot more straightforward. It also doesn't require you to recapture any of that deduction you took when you sell your house. So just a side note on that one.
Yeah, and we do have a question, and I think it's a good question. You definitely touched on this, but it gets tricky, I think, to figure out, for example, what percentage of the internet use can I write off? And essentially, if I understood you right, you really have to try to think about really what percentage of it did you use specifically for that business. So the question that came up was, my husband works from home and I have a consulting side hustle I do part-time from home. Can we, oh, she said, can we both write off the internet expense if we file jointly? But I think it'd just be for the side hustle and the percentage of time used for that. Is that right?
Yeah, with the uh, a lot of people working at home. I got asked this question a number of times this year. They're using their own, cell service, a chunk of their house, and so on. Unless Congress changes something, starting with the 2018 Tax Cut and Jobs Act, we who are a W-2 employee don't get to deduct on our own return any costs for doing that work at home. We have to be, if we're going to get paid back for it, it has to come from our employer. And if you're on a joint return versus a separate return, it's the same rules. And so you'd want to, for the person who's got the independent business, oops, I think I lost my slides. Yeah, for the person with the independent business, they have the vehicle, the Schedule C, to take part of that use of the different things at home. But it sounds like the husband on that one, as a W-2 employee, they just don't, the employer could reimburse them, but that's usually tied to an accountable plan. You got to talk to your employer about it. It's just, yeah, not something that's an option.
Good answer. And so when it comes to, in this example, the other partner working on a side hustle from home, when she's trying to figure out how much of the internet use was for that, is your best guess okay? I'm assuming a lot of people don't know. It's pretty hard to figure out the exact.
Right. Yeah. And so in this area, it would be really tough. I can't imagine having like a minute by minute log of what you're doing, because it's real easy to be working on a document or a response, and an email pops up that you're going to quick answer and then come back. Kind of same thing as if you get a call from family and then you let that go and get back on it. So your minutes they're going to be off. So we basically reconstruct it to say, okay, if you're on the internet, for example, 2 hours a day, in our, pre-COVID world, maybe, and in with COVID situation, you're maybe at home on it, closer to 10 hours a day, and can say, oh, yep, 6 of them were solid for my W-2 job. 2 of them were for fun, streamed a movie, and 2 of them were for work for this side hustle business. And look at it for a week, and then if your level of business is pretty steady throughout the year, then just multiply out, get your percentage that way. It's you have to have something to stand on, and that kind of calculation, putting that kind of thought into it, will is supportable. It's the one for sure thing is it's never supported that um, business use of something that has personal aspects to it could never be 100% deductible. So someone who's saying 100% of my cell phone, I never, it's all business, um, unless they have another phone, pretty unlikely. So yeah.
That's a great point. So really, no one would be writing off 100% of their internet, or rather, I can't imagine the person who only uses the internet.
Yeah.
Their side
Yeah.
hustle never touches Netflix or anything else. So it's really
Right.
always going to be a percentage. And then that's a really good idea to take a smaller period of time and analyze how much
Yeah.
you're using it and multiply it. Because otherwise, it would drive you crazy, I think, to try to log every single day.
Yeah. Yeah.
Perfect. And so then her other question was same question, read the use of a home office. And I think you touched on that too. And I've heard this as well as a freelancer. It really, the purpose is you have to just be using that space for your business. Is that right, Kim?
Yeah, it's this exclusive use. There's some exceptions. There's a lot of exceptions to things, and so they'll have differences if it's a daycare, which is an intense business more than a side hustle. Um, but typically, that's what it comes down to: is it's exclusive use. It could be a second bedroom, but it's not your kid's bedroom and your office during the day for it to be exclusive use.
Right.
Yeah.
Yeah. Okay. Great points.
Let's see. Oh yeah. Um, a lot of people with the side hustles will get 1099 forms, and the IRS kind of resurrected this 1099 NEC form for 2020 so that they could deal with the fact that a 1099 miscellaneous has very recently had different deadlines depending on which portion of it someone was using to issue it for. So you should expect to see, instead of 1099 miscellaneous issued to you for your services or work, it's going to be 1099 NECs this year. It's not a whole lot of a different form. It's still non-employee compensation. It's still someone who's doing work for um, another business, like maybe it's a manufacturer who needs additional packaging help, but they're not wanting to go to the expense of hiring people on, so they pick them up as contractors. It's kind of a gray area whether they should pick you up as a W-2 employee in that instance. But yeah, the forms that you receive when you do receive a 1099 will be a little different this year. Oh yeah. So the taxes you want to set aside, and keep in mind that you don't, I mean, you have a net profit, but you're going to pay tax on it. So you just, when you're setting your prices, you're setting your amount, or you're thinking about what's my take home pay from this. It's unlike your W-2, the taxes haven't been taken out of it yet. So it's pretty much close to whatever your net is. You're going to pay 15.3% of that in self-employment taxes. That's once your net profit is over $400. That's where that kicks in. And technically it's on 92.35% of your net profit. But basically think about 15% of what you net is going to your Medicare and Social Security, because you pay both halves when you're independent. You're going to have federal income tax, and if you're here in Iowa and a lot of the states, you're going to have state income tax on it. The nice thing that they did in 18, federal, and then Iowa picked it up in 19, is giving you a qualified business income deduction. So when you are an active business like this, the first for federal, 20% of that net profit, you're not going to pay federal income tax on. Iowa is kind of easing into it. So this year, instead of 20%, they're giving us half of the federal. So they're giving us 10% off of the net profit before they apply income tax. So however you're doing your taxes, um, the, most of the software is doing a good job of catching this as it goes, but you should expect to have a line on your federal and your Iowa tax return saying how much qualified business income deduction you have, so that you're not paying federal income tax and state income tax on the full net profit. So that's a help now for the side hustle.
And that's interesting. I didn't know about that actually. And is that something that happens automatically, did you say, or is that something freelancers will have to take action on to make sure happens?
You want to make sure. It kind of depends how you do your taxes. You can still do them by hand. I calculate them on a form that way, but most people will do them on a computer, either themselves or they'll have someone like me prepare on a computer. And the software uh, that I use, as the professional software, has its screen entry, has me electing that it is an active trader business, has some other data I put into the calculation to calculate the deduction. Uh, as far as doing it on your own with computer software, the different stuff I've seen, they ask the questions, so it should lead to that deduction happening. But I would take a look at the final product before you submit it and see if, and again, they actually just issued the final 2020 1040, the federal form today, and I haven't looked at it to see what line it lands on. Iowa, it was landing, oh gosh, right around line like 30 something. So you just want to look at, it should be page 1 of each federal and Iowa 1040 that have the qualified business income deduction happening on there. The one thing that you might want to watch for, especially on a joint return with Iowa, the software didn't always calculate it, tie it to the person whose income it was. So if you just have one person with a side hustle, you want to make sure the deduction lands on their side. But yeah, that I just did an amended return for a couple who didn't take it the last 2 years on her income. She's freelance, and so we're amending those returns to get that related tax back. But it's the software is pretty good. It should be happening, but I would look at your returns because you can always amend basically for 3 years after you filed it. If it didn't get caught, you can go back and fix it.
Point. Okay, that's interesting. I wanted to bring up one example too. I have a friend who does several things on a freelance basis, and I know she takes a certain percentage of her income and just puts it in another bank account just to prepare for taxes. So I was wondering if that's something you would recommend, and if so, what does that really look like for non-math people like me? Like, so when you earn
Oh, just
$100,
as
you're putting $15 to $20.
right, yeah. Typically for someone whose side hustle has become more of their main income, a quick and easy guideline, if you're in Iowa, is to say, set aside 30% of your profit for your taxes. Like I said earlier, about 15.3 is going to self-employment. Depending on other income, this could be something you're paying 10% on your federal. It could be 10% gets used up and you're using your 12. For Iowa, top bracket is a little over 8% right now. Most people are more in like the 5. So if you set about 30% aside, the other thing to keep in mind is both IRS and Iowa, and probably every state in the union, have penalties if you don't pay as you go throughout the year. So you end up calculating when you have a regular income to pay that additional tax on, you end up calculating how much quarterly to pay in as you go so that you don't get tagged with a penalty for not paying as you go. Um, we'll definitely have a lot of people who will have uh, the side hustle, is it's significant, but not um, out of control in that they could use their W-2 and jack up the withholding on it to cover those taxes so they don't have to do an extra payment quarterly to cover it. But I would, especially when you're just starting out in something you're just not quite sure how it's going to go, do set aside about 30% of your net profit for your tax.
That's a good point. And I always found that strange too for freelancing and side hustling. So to pay quarterly when you're not quite sure what you're going to earn, that's a tricky thing to do.
Yeah. I mean, you can, to avoid, they have a couple different ways to decide that you don't need or don't have to have a penalty if you have a balance due and you, this would be kind of regular rules, they do occasionally get changed. If you have a balance due, but you paid in 90% of what you owed by the end of the calendar year we're doing taxes for, there shouldn't be a penalty on top of that. Or if you had already paid in 100% of what you owed the prior year, for high income people, that's 110%. So usually, again, software by hand calculated on the prior year tax return, you'll have what's recommended for you to pay in as you go so that you would meet those benchmarks. So even if you have a surge in income, like something just comes out of the blue and someone really needed something you could do. So you have the surge of income in December and you've already made your quarterlies. You don't necessarily need to worry about getting the fourth quarter, like an additional payment made on it to avoid a penalty, based on as long as you paid in according to that, either 90% of total what you owe, or like you said, either 100 or 110% of what you owed the prior year. So you've got some guidelines, but yeah, and that's something I did a lot of this year. It seemed like in the off season, semi off season, is recalculated for people. That second quarter was huge, changing what we were paying in based on what we had earned. I mean, for people who had, especially their main income from something that they had to literally close down, like the salons. So that changed second quarter greatly. Happily, a lot of them that I've done are building back. And so they've been doing pretty close to the calculated ones for third and fourth quarter. But like you said, if you don't have in-person interviews and that kind of stuff, it really changes the potential for the income.
Definitely.
Okay. And let's see. Oh, and this is the last one. I just wanted to make sure I gave some resources. These are all irs.gov, but they've got obviously the publications, forms, examples. That top one is specifically about the sharing economy, or what they also call the gig economy. So anything that involves, whether you're doing like an Airbnb at your house, you're doing Uber driving, and essentially sharing your use of personal property to have income. The Schedule C, of course, reference talks you through the form nearly everybody is going to put their side hustle on. And the small biz is for businesses with under $10 million in assets, which I'm pretty sure is most people's side hustles don't quite involve that much in assets. So
Mine does not. Perfect. Well, keep entering any more questions that you have for Kim. And in the meantime, if anyone's doing that, I'll just ask you a couple quick ones that I thought of, if that's all right.
Sure.
So What do you do if you've had a couple expenses, but you haven't started earning revenue yet? Like I'm imagining someone who, say in November or December this year, they buy themselves a website, they're starting to get things up and running, but they don't earn revenue till the next year. Does that make things more complicated regarding taxes?
It kind of depends. The example you used for like doing a website, um, expenses that aren't, really um, high or aren't involved in buying more of an asset that's going to be used over multiple years. Like if someone was starting a business and they bought all kinds of kitchen equipment because they were going to do baking or whatnot. Um, if it's more of a annual cost type item like the website costs each year, you can still go ahead and do for that year your business, which might not have any income but has these expenses as you're starting it up, and have those as deductions. If you were buying like I said, the kitchen equipment, you would want to, they call it capitalize. So you'd want to consider those costs going to be your startup cost, and to not deduct any of those until you really have the business open and start to have that income happen. Um, from an accounting standpoint, it's really nice because you're kind of matching your income with your expenses. Um, but for your example of starting stuff up November, you have some small expenses, but they're not the kind of thing you would really say is going to do you any good next year. They're really just covering the website's cost this year. Then yeah, you can start in this calendar year having that business on your tax return.
Gotcha. That
Yeah.
makes sense. Um, what about, I was just thinking about people who might even have more than one side hustle. Let's just, as an example, say driving for Uber and freelance graphic designing. Does that get kind of messy as far as, I don't know, I'm trying to picture how it works.
Yeah, so you definitely want to keep separate records, and one of the guidelines for whether it's a hobby or a business is how do you keep your records separate from your personal. And one of the suggestions right away is to have a separate bank account. So ideally, all your expenses and your income go through there. With Uber and graphic design. I mean, you'd have to keep the income separate. At least with Uber, there's probably a platform that you're just going to get all that income reported to you, in, and so you can keep all the freelance graphic design, the payments you received, and that kind of thing separate. Um, and then that could be the messy thing is if you're, on your way to pick up supplies or go to meet a client to design something for them, and you decide to pick up an Uber ride along the way, you've obviously got multiple use of your vehicle. So I don't use one yet myself. I just keep a little ledger record in my glove box. But there are apps for doing the mileage tracking to keep that separated. I think there's, particularly people who do things like sell real estate. So they're out and around all the time, will have something like that. So each trip is kept separate. Like when you stop, it separates it out, and then you can set up the app to recognize that all of the stops at, Home Depot are for supplies, and all of the stops at the airport are for Uber or something like that. So yeah, if you're getting multiple things that use the same asset for different activities, that they have to be kept separate on separate Schedule Cs on a tax return. Um, then you want some way of delineating the activities. It's not impossible, but this is one of those areas of life that really puts you to the test of being organized.
Yeah, yes, definitely. Good point. Okay, Madeline asked a great question, and this is a biggie. She said, is there a point you recommend forming an LLC for freelancing if you
Oh.
that.
Yeah,
And I will mention, I know for myself, I registered for an EIN at least, simply
sure.
not really for tax reasons, but because I kept having to put my social security number on all these different forms for all these different outlets, and that was starting to make me crazy. And I thought probably not the best idea. So anyway, so an EIN might be a good thing to bring up in this topic too. But yeah, what about forming an LLC?
Yeah. So an LLC, limited liability company, is recognized by most states as an entity type. So you're registering, for example, if you were here in Iowa, you'd be registering to do business likely in Iowa under that LLC, and I would ideally get an EIN under that name and then register it with the state of Iowa. Um, the EIN, the employer identification number, isn't required if you don't have payroll, like the payroll taxes and returns. If you do, you have to have that EIN to do that part of the paperwork. Um, but it's nice to have the EIN because then, like you mentioned with forms, say your business is big enough that you're having people do contract labor for you. You're not big enough to have regular employees, but you're big enough that you're paying some contract labor wages. So you're issuing that 1099. Then your EIN goes on it rather than your social as a identification number. Also, using that EIN to open the bank account specific to the business is great. Back to the LLC. So it has implications both for your liability protection, which is separate from taxes, and it also has implications for how you report your business on a tax return. So for the liability, which is why a lot of people go ahead and apply for it. So it would limit your liability, just kind of what it says, to the assets that the business owns rather than getting into your personal. And we'll just have a quick caveat that I'm not a lawyer or attorney. So this is the basic knowledge that I have by doing taxes is how it limits you. So the point at which I would do an LLC, uh, for protection would be at the point at which you have substantial assets um, uh, on your own that you want to protect if the business doesn't survive. Then, or if you're in a business that's somehow high risk. I mean, that would likely be a type of business. One of your expenses would be insurance anyway for the business, which should cover you. But yeah, that's for the liability. When you form an LLC, you just want to keep in mind how many members are there of it. If it's you on your own, it can be as what's called a disregarded entity on your tax return. So you don't have to do anything different. You still put your activity typically on the Schedule C. Same as if it's a married couple who's on the same return. But if you form an LLC with someone else who's on a separate tax return, then you have now created an entity that cannot be, it's the tax return for that entity has to be done separately. And the default is a partnership. So you end up doing a separate partnership return, a 1065, having to issue K1s to the members of it. And those K1 forms, kind of like a W-2, gets reported on your personal tax return. At that point, a lot of times when people want to form a business with someone else, I advise going beyond the LLC to form a corporation and elect to be treated as an S corporation. So you still have a pass through, but you've got a lot of protections because of the structure, which gets into a whole nother area about being in business with someone else and making sure that things are kind of black and white with it. So you don't have that gray area that can lead to people being uncertain and not working well together.
Yeah, and I know that's an even bigger topic. I know, yeah, I mean, is it fair to say that a lot of it has to do with the amount of risk in your business? I know, like for freelance writing, that it's not impossible that someone could sue me, but it's pretty unlikely, especially given the types of things I'm writing. So I know for me, I haven't formed an LLC just for that reason, and because I know there's an expense to do so. But obviously, if you're in a higher risk business, it seems like it might be something to consider.
Yeah, absolutely. Because like you said, it is an expense. I mean, you are filing with the state, you're keeping paperwork up there. There's, you have to keep filing that paperwork and keep renewing it. So unless you were running a risk, or of course, if you want an entity name to be on the paperwork and not your personal name,
Right.
then you would go that route.
Right. One more question. This is just one I thought of. What are there things that are always no's as far as things you can write off? So I'll give an example. One that comes up a lot in chat groups that I've seen is like clothing. Like, hey, I'm a freelancer. Can I write off my clothing? And people are always like, no, you can never write that off, even if you're wearing it while you're working. Are there examples like that that apply just pretty much across the board?
Yeah, I mean, yeah, there's court cases that help define it. If you were, you had a uniform, right? Or you had safety clothing, like it was the brilliant yellow vest that you'll see on people who are in the roadways and have to have that protection. Um, those are essentially clothing, but they're protective gear. And so those will be a deduction for, perfect example, someone who goes into business in the construction field, but they're doing more tree removal for, derecho damage. They might have bought additional safety vests for themselves and anyone working with them to wear. So those would be a deduction. A classic example is someone I can't remember how many years ago, but there was a court case with a person who is a TV personality, I think with a news program, who intended to claim as a deduction their clothes, and they were very nice clothes that they bought and would appear, on television in them, felt that they had to make those purchases of those higher end clothing items to do their job. But if it's considered regular wear, a street clothes is another phrase for it, it's not a deduction. We're not going to get to so across the board. Other ones that come up kind of get people in trouble are meals. You'll hear people say, well, you're traveling, so you get the meal cost. You got to look at the definition of traveling from the tax code point of view. It's when you leave your tax home and you're gone for substantially more than a day's work. So an easy way to think of it is if you're not gone overnight from your home, you're not going to have traveling costs like lodging or meals. The other type of meal, that you might come up with in a side hustle situation would be meeting with a client or a customer, or someone who's going to do work for you, and you're kind of hosting and conducting business, obviously, during the meal. So that's going to be, as long as it's not lavish, is the term they use, you're going to be able to deduct it. But the other thing about it is the meals like that, both the traveling and the meeting with customers and clients, you only get to deduct half of it. So it's kind of a sinkhole area of expense. If it's not really something you need to spend money on to conduct business, I kind of avoid it, because it's you don't get to deduct it entirely.
Yes, good point.
Yeah.
Well, that's all the questions the group had. Anything else you want to touch on, Kim, before we wrap up?
Oh, just kind of back to that idea of organizing. Just know that when you start something like this up, unless you're such an instant success that you can afford to have someone else do your bookkeeping for you, work into your business plan, however loose it is, that you're going to spend some time putting your details together. You've got to have that figured out before you do the taxes, and you got to hold on to how you put together your income and your deductions, unlike a W-2 where you get the form and you're good to go. This is a type of income that you need to be able to substantiate where the income's coming from, that you claimed you got, and and the expenses that you're taking against it, that those existed and were, ordinary and necessary. So it's not everybody's favorite thing to do, but you just have to factor in it's going to take time to do the record keeping for your business.
Yeah, good point. And unpaid time. So that's definitely something to think about.
Yeah, you don't get to deduct it. So no. Yeah.
Good point. All right. Well, thank you so much for talking to us today. That was great. If anyone watching is wanting to direct someone else to this information, we did record it and we'll put it up on the City of Marion website. So just FYI, but that's all we have. Thanks again, Kim. That was great.
All right. Thanks.